Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Newmont stock so we can determine if it's a buy or a sell. Newmont is the world's largest gold mining company. It owns gold mines in Nevada, Colorado, Ontario, Quebec, Mexico, the Dominican Republic, Australia, Ghana, Argentina, Peru, and Suriname. In addition to gold, Newmont mines copper, silver, zinc, and lead. They are spending $500 million on renewable energy projects through 2025. Their goal is to reduce carbon emissions by 30% by the year 2030. The company is headquartered in Denver, Colorado, and was founded in 1921. Let's get started with the model. This is a large cap company, 40 billion market cap. They're trading at $47 a share, and they have 834 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grew a lot from 2019 to 2020. Then it dropped in 2021, and it dropped even further in 2022 at 1.1 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was really high in 2019 and 2020, but really low in 2021 and 2022. Revenue is a sales for the company, and that peaks in 2021 at 12.2 billion. It's a little under 12 billion for 2022. Obviously, the price of gold really influences the company's revenue and profits. Let's look at the capital structure. They have 19 billion of equity, 6 billion of debt. They're 76% equity, 24% debt. Their net debt is 2.4 billion. So that means they have about 3.8 billion of cash on their balance sheet. And their WACC, weighted average cost of capital, is 10.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 39 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $36 billion. We divide that by 830 million shares. And we get a calculated stock price of $43. They're trading at $47, so they're trading at 11% premium. It's a sell according to the model. Simply Wall Street values the company at 56. They're saying it's 15% undervalued. 11 analysts priced this stock, and the average price target is 59. The lowest 50, the highest 69. 21 analysts priced this stock, and the average price target is 57. They say it's 20% undervalued. This is where the stock has been trading since 2002. In the beginning of 2002, it was $20 a share. About 15 months later, it doubled to $40. About 2 years after that, in 2006, it tripled from 20 to 60. It did drop down about $25 during the Great Recession, but over the next 4 years, it broke through $70. Then it got real low to about $10 a share in 2015. That was really a low point. If you could have picked it up around then, it would have been amazing, because it did break through $80 in 2022. It got close to 90, about 87 at its all-time high. But the stock is down about 50% from that high point. For the past year, the stock has been averaging around $45 a share. They consistently pay a quarterly dividend. They did cut their dividend in the first quarter of 2023. It was 55 cents in 2022. They cut it to 40 cents. It's still a good yield, 3.37%, but that's 123% of their free cash flow. So they definitely have to either bring in more free cash flow or possibly cut their dividend again. There are 43 companies in the same industry as Newmont, and if Newmont has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They do spend a lot on CapEx. That's why they had low free cash flow in 2022. Their debt to equity ratio is between the median and average. For every dollar of equity, they have 30 cents of debt. They pay a really good dividend, a lot higher than the median and average. They generate a lot more free cash flow than the average. They are the largest company, a little bigger than Barrick. All their ratios are worse than the median. They generate lots of revenue, the most on this list. Their 5-year annual revenue growth rate is higher than the median and average. And since they have negative net income, they have a negative ROA and ROE. So to summarize, I have them trading at 11% premium. I rank their free cash flows and revenue 5 out of 10, and their ratio is 4 to 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.